Welcome to the deep dive. Today we are cutting straight to the core of what's happening in global finance. We're focusing on open banking and, really, its much bigger vision, open finance. If you're watching the digital economy, this is the plumbing being built right under our feet. So let's get our definition straight. Open banking, at its heart, is about securely sharing financial data.
Right. Things like checking accounts, transaction history.
Exactly. And it's all done between banks and licensed third parties using standardized APIs. And this is the key part. It's always based on your permission as a customer.
And then open finance just blows that whole concept up. It takes that idea and expands the universe.
So it's not just your checking account anymore.
Not at all. Now we're talking about everything. Pensions, mortgages, your insurance policies, investments. It's about building a single sort of digital identity for your entire financial life.
And that's really our mission today. We want to unpack this defining tension that's reshaping this space.
Yeah.
We've seen a fundamental split globally.
A huge split.
Some countries, like the UK and India, they came in with a regulatory stick. They forced the change.
They mandated it.
Mandated openness, mandated standardization. But then others, and the U.S. is the big one here, they sort of let the market run wild first.
Letting companies drive the change organically.
Which leads us right to the core question we want you to think about as you listen. Which path, the strict mandate or that pure market evolution, which one actually supports sustainable consumer empowerment?
And safety. And, true interoperability in the long run. That's the real debate.
It is. And to understand it, we have to start where it all kind of began, which is that market-driven evolution in the U.S.
Right.
In the early days, this movement wasn't coming from the Fed or the Treasury.
No, not at all.
It came from you, the consumer, wanting to use budgeting apps, things like Mint or investment platforms like Betterment.
That's exactly right. The early pioneers of this connectivity were companies like Plaid and Yodlee. They were the ones connecting your bank account to these cool new apps.
But they did it using a technique called screen scraping.
Yes, screen scraping.
Okay, that phrase sounds pretty technical. For anyone listening, what does that actually mean and why was it necessary, but also kind of flawed?
Well, it means the app, the third-party app, essentially logged into your bank account as you.
Wow, okay.
It was literally simulating human keystrokes. And this is the crucial part. It meant you had to hand over your actual bank login credentials, your username and password, to that third party.
So it's just a workaround.
It was a digital workaround, yeah.
Okay.
Not a feature the banks built in. And while it gave consumers what they wanted, linking a budget app to a checking account.
It was a huge security liability.
It's massive technical and security liability. I mean, you have a fintech storing thousands of bank credentials. That's a huge risk. And the banks, who never really agreed to this, had no way to manage that risk if something went wrong.
So consumer demand basically created this brittle, risky system.
Precisely. The market created the demand, but it completely failed on the safety and standardization front.
Now, what we've seen over the last few years is the industry sort of organically shifting. They're moving toward formal APIs to fix this.
So they're fixing it themselves.
Banks and fintechs are cooperating now, moving away from screen scraping because, honestly, the liability just got too big. But, and this is key, this shift is voluntary. It's driven by business deals, not by a regulator saying you must do this.
That's the main difference, isn't it? The APIs exist, but they're not standardized across every single bank. So the innovation is fast, but the whole system is kind of decentralized, patchy. So if the U.S. model is just relying on consumers wanting stuff and banks slowly coming around, what happens when a bank just says no? Or when consumer safety is really on the line?
Well, that's the big question.
And that's where it gets really interesting, because we see this pivot to hard regulation, with the UK model becoming the global benchmark.
The UK approach was a seismic shift. It wasn't about negotiation or voluntary agreements.
It was mandated. It was mandated, driven by two things. The EU's Payment Services Directive 2, or PSD2, and specific rules from the UK's Competition and Markets Authority, the CMA.
Okay.
And this legislation didn't just suggest openness, it forced the 9 biggest UK banks to build standardized, secure APIs. The technical clarity there is it's everything.
Why is standardization so important?
Because it means a fintech only has to build one integration, just one. And they know it'll work across all the major banks. That dramatically lowers their costs and lets them launch new products so much faster.
And that liability problem we talked about earlier,
Yeah.
the one with screen scraping,
Yeah.
that was solved, right?
Absolutely. That the regulation created a whole new category of company, the licensed third-party provider, or TPP.
Okay.
And these companies are licensed and regulated by bodies like the Financial Conduct Authority. So that solved the security problem. Now, if a TPP accesses your data, they're accountable. You have someone to go to if things go wrong, and the banks know exactly who they're dealing with.
And that structure it unleashed a wave of innovation.
A huge wave.
The U.S. model couldn't really match at first because it was so fragmented.
Yep.
We saw the immediate rise of digital banks like Monzo, Starline, Revolut, yeah. And they used these connections for things like instant credit checks and amazing budgeting tools.
Yeah.
It created real competition overnight.
And that's why the UK model is now studied globally. It's the benchmark because it proved that regulation, if you do it right, can drive innovation and competition while still keeping consumer protection front and center.
And that became the blueprint. We've seen similar regulations pop up across the EU, in Australia, and Brazil has been a huge one.
Brazil's system has grown incredibly fast, and it's seen as a model for emerging markets because they designed it from the ground up to cover everything: banking, insurance, investments, a truly complete ecosystem from day one.
Which takes us perfectly to India, which took that whole mandate idea and just expanded it on an unprecedented scale.
Yeah, India's system, the Account Aggregator framework, it's fascinating.
It's not just about compliance, is it? It feels more like critical infrastructure.
It is infrastructure. Customers can securely share data across banks, insurance companies, pension funds, investment platforms, all four pillars of their financial life.
So what's so special about the architecture there?
Well, beyond the scope, it's the architecture itself. It's highly decentralized. The account aggregator never actually stores your data.
Oh, that's interesting.
It just acts as a secure consent manager. It facilitates the flow of encrypted data from the provider to the user, and only with your explicit permission for that one transaction.
So that's a massive step forward for privacy.
A huge leap. And it's all enabled by the digital infrastructure that India already had in place. The Aadhaar digital ID system and the UPI payments platform. Those systems make the whole process instant, verifiable, and incredibly secure.
Okay, so that is the comprehensive mandate at scale. Now, if India is sort of the ideal structured ecosystem, China is the perfect contrast, the platform alternative.
Right. In China, openness was achieved. Well, internally, inside the walled gardens of their super apps.
Alipay and WeChat Pay.
Exactly. They created these massive ecosystems with extensive data sharing, but it all happened within their closed systems.
Yeah.
They show what platform-driven financial integration can do at just an unbelievable scale.
But that's the key word, right? Integrated, but not open in the way we've been talking about.
Not at all. The data is proprietary. It belongs to the super app's parent company, and your ability to take your financial history and move it to a competitor is, well, it's very limited.
I see. So it's data integration, not data liberation.
That's a perfect way to put it. Now,
Yeah.
regulators in China are starting to formalize things around data security, but historically that's been the model. And just to mention a more balanced approach, Singapore is somewhere in the middle.
Right.
They encourage open APIs through things like their API playbook, but it's more about collaboration between regulators and banks, not heavy enforcement.
So we have these different systems, some built on firewalls, some on mandates, some on internal platforms. What does all this actually mean for the person whose data we're talking about?
At the end of the day, the theme across all of them is consumer empowerment. The fundamental shift is profound. Your financial data moves from being the property of whatever institution holds it to being an asset that you control.
Which gives you more transparency, more choices.
And most importantly, control. Control over who uses your information and why.
Let's talk about some real-world benefits. Open banking gives you powerful account aggregation, right? So you can see all your accounts, checking, savings, credit cards from different banks, all in one dashboard.
That's the baseline, yeah. Essential for just basic budgeting. But Open Finance takes it to the next level.
How so?
By bringing in pensions and investments, it opens the door for things like cross-platform credit scoring. Lenders can get a much more accurate, holistic view of your financial health.
And that could lead to better loan terms.
Potentially, yeah. Especially for people who might be underserved by the old, simple credit score models. We also see payment initiation services.
Instead of using a credit card online.
Right. Instead of relying on expensive card networks, open banking lets you make direct bank-to-bank payments. It can lower fees for merchants and speed things up for consumers.
The irony here is that for the traditional banks, this whole movement is both a massive challenge and a huge opportunity.
Oh, for sure. The challenge is obvious. They have to untangle decades of old monolithic IT systems. That's a huge amount of tech debt.
And then they have to invest a ton in building secure, scalable API layers.
It's a massive, expensive modernization effort, especially with all the cybersecurity and compliance rules in places like the UK, but the opportunity is just as big.
Yeah.
Banks can finally collaborate effectively with these specialized fintechs, turn rivals into partners.
And they can use the data to offer better products.
Exactly. Move beyond generic services. They can offer hyper-personalized advice, use the combined data for much more accurate real-time credit assessments, and get insights that slash fraud. They stop being just vaults for money and start becoming, true financial partners.
Which brings us back full circle to our global tour. We've seen the organic market push in the US, which gave us speed but struggled with standardization.
Mm-hmm.
We've seen the mandated clarity of the UK and EU, which prioritize protection and standards.
And we've seen the comprehensive, infrastructure-led ecosystem built in India.
The shift itself seems irreversible.
It is. We're moving finance from a closed, institution-led model to one that's open, efficient, and driven by customer control. The approaches are different, but the direction of travel is the same everywhere.
And as we said, the growth of investment apps and robo-advisors proves that a kind of industry-led open finance is already happening in the US, even without a central mandate. Demand is king.
It is.
But here's the final thought for you to consider. When we talk about long-term sustainability, and especially about maximizing consumer safety and achieving true universal interoperability at scale, does the U.S. model, with its speed but lack of standardization, eventually have to adopt the kind of regulatory clarity we see in the UK or India to really secure its future? That's the question that will likely define the next decade of finance.